It's embarrassing just to say it right now. I lost 20,000, and I'm glad that I didn't lose more, because after I sold the stock, it kept going down. But that experience made me reflect on my investing journey. And so from that experience, I now have 10 principles of investing that I follow that has saved me probably more than $20,000 ever since that fateful day that I wish had never happened. Number one, don't chase the hype. Do not follow anything on Reddit. Just don't. There is no way for you to know what will happen to a stock's price in the short term, no matter how sophisticated someone sounds on Reddit. Please do not listen to what they say like I did. Don't assume someone knows better than you. More often than not, it's a situation where the blind is leading the blind. It's just that the blind leader is weirdly confident and convincing. Number two, I want you to understand that emotional decisions are bad investing decisions. Now, I get it. Sometimes you want to support stocks that are environmentally friendly. By all means, do that if you want to, but you have to make sure that your decision to invest is not an emotional one, not because you like the company and you want to support it, but because the company actually generates cash flow and has a competitive advantage that is enduring over time. If you don't understand financial statements, you shouldn't even be buying individual stocks. If you have to check how the stock is doing every single day the market opens, you shouldn't be buying that stock. Number three, don't time the market. Let me say it again, don't time the market or any individual stocks. Now, don't get me wrong, there are moments in time when a stock is underpriced to the point where it does not make sense. But usually you do not realize that those are the moments until after the fact. When Mark Zuckerberg had to testify in front of Congress like 6 or 7 years ago, Facebook was below $100 and you could have bought it at that price. When AMD announced their new Ryzen chip back in like 2017, and my computer science friend told me back then that that chip would revolutionize the industry, which it did, and skyrocketed AMD's price, I did not believe him. And guess what? If I had invested during those 2 times that I just described, I would have a lot more money than I have right now. But there was no way for me to tell where the stock was going at that time. And there's usually never a way to tell how well a stock is doing. And so in Tony Robbins' book, Unshakable, he says that more money is lost by not being in the market than anything else. If we miss the best performing days in the market, our return can literally get cut in half. And so it might literally be better to just buy and hold and forget about it. And so right now, I bought an index fund, I'm forgetting about it. Unless America as a country stops growing, I'm good. But that leads me to my 4th point. Do not sell unless your thesis has changed. So a lot of people recommend index funds, like an S&P 500 index funds. Buying an S&P 500 index fund is based on a huge assumption that the American dollar will continue to do well, that America as a nation will continue to prosper. If that thesis changes, then the stock market might become less attractive as capital, money, flows out of the country. And so this means whenever you buy a stock or a fund or anything, you have to understand the reasons why you bought. And if those reasons, those assumptions, those first principles change, then it's time to reevaluate your decision and decide whether or not you should sell. Number 5, don't get fancy. Don't try to create your own hedge fund by buying a stock and then buying options and then making all of these complicated bets that depend on certain things happening on certain days. Just skip all the mental stress that you're gonna put yourself through. Why? Because stocks and investments are not actually the best compounding vehicle of wealth over time. You are. And so it's much better to actually just figure out how to make more money instead of relying on the stock market to do so. And number 5 also relates to number 6, which is complexity is bad. If a company is trying to sell you a financial product and they cannot explain what is in the product, that is trouble. If whatever you're trying to buy comes with all of these conditions that say if you sell within a certain time, you have to follow this step, you have to call this number, you have to wait 30 days, that is also bad. It is too complicated. Just go buy something simple. It is often simpler to just open your own brokerage account and do everything yourself. Number 7, don't speculate. Anytime you're trying to buy something because you think the price will go up in the short term, is speculation. You are betting that demand will continue to increase, but you never know. It's different from investing in an index fund where you know as long as those businesses continue to make money, you are good to go. Good investors now understand that speculation and investing are two different things. Number 8, you should probably understand that you probably won't beat the market. Most individual investors don't actually beat the market. Believe me, I've tried. I have a finance degree, and I honestly haven't been able to beat the market consistently. And so if you can't beat them, join them. That's why I just buy index funds now. Number 9, if you actually want to make money, then fees matter. There are 2 kinds of fees. One are management expense ratios that you have to pay when you buy into a certain fund. And so you always want to minimize those, especially if you're just buying a passive fund where the manager isn't trying to beat the market. And so the second kind of fee are trading fees, which comes in the form of a spread between the ask price and the bid price, as well as the commission you pay on every single trade. And so that means the less you trade, the lower your fees. And so the way I minimize fees for myself is to buy index funds that have the lowest fees. And if I ever am going to buy a stock, make sure that I am at least willing to hold for 5 years, assuming the thesis does not change. And then finally, number 10, and perhaps the most counterintuitive of all, investing won't make you rich. If you do the math, all investing will do is keep your money protected against inflation plus a little bit more. Investing for regular people will not help you buy a Lamborghini when you retire. The only kind of people where investing can build true wealth for are people who are making a high amount of income from a business or their job. Which is why I think what traditional FIRE and financial minimalism teaches is totally out of date. And that's also why I've since adopted a new form of financial minimalism called New Financial Minimalism, which you can learn more about in this video.